Hi there everyone, a very good evening and welcome to the Money Show right here on ET Now. We're going to bring you top financial experts in order to answer your queries. Please call us on the number that's flashing at the bottom of your screens over the next 30 minutes. You can send us queries on invol.in or even an email query with your portfolio. Well, let's get things and get the ball rolling with Feroze Azeez, Deputy CEO Anand Rathi, Private Wealth Management, who joins in first up on the show. Welcome to the Money Show, Feroze. Great to have you with us. Let's begin with a discussion pointer and understand mutual funds versus portfolio management schemes, PMS. What exactly are the differences and would there be a preference or towards any one of them?
Correct. I think if you look at differences, mutual funds are a retail instrument which you can invest almost as little as 1,000 rupees, but PMSs come with a minimum 25 lakh rupee threshold. Avan, I can hear my voice again, so if you can fix that.
It's going to have that.
So anyway, so mutual fund and PMS, point one, I think the line is a little unclear, Avan. From a mutual fund standpoint, the second big difference is that mutual funds are more diversified. PMSs are...
Okay, I believe it's A-okay now, so yes, go ahead.
Brilliant, Avan. So now I can hear you. So point two is that you have a more concentrated portfolio in the PMS. When you measure risks, PMS are marginally more. Because they hold fewer stocks, maybe 18 to 25 stocks, but mutual funds end up holding 45 to 55 stocks generally. The third difference is the experience of the fund manager in the PMS side is marginally lower, but on the mutual fund side it is upwards of 15-20 years average. The number of analysts which support a portfolio management service is again a little fewer than mutual fund. From a preference standpoint, I would prefer a mutual fund for a person who has not gone through the full journey. If you are an HNI, maybe you can consider one or two PMSs, but the cost is marginally more on the portfolio management service. The tax is more because the demat account used is going to be your own demat account and it's not a pooled account like in mutual fund, especially in the long-term capital gain regime of equity. PMS would score fairly low on the tax efficiency bit vis-a-vis the mutual fund. So I think the merits of mutual fund overweigh on risk, return, experience of fund manager, tax efficiency, cost. So I would vote for a PMS better than a mutual fund better than a PMS, especially for clients who are not looking at investing anything above 25 lakhs because the ticket sizes are low on the mutual fund side.
And even from a tax perspective, you've highlighted that it would be a preferable option. So for those of you, if you were curious to understand how PMS works, I'm sure Feroze threw more light on that. And he said that if you were to choose between the two, it would definitely be veering towards mutual funds. Hope you've got note of that. We got lots of queries lined up. Get those phone lines going and send us an email query as well. Well, first up, we've got Prashant's query. He says, I've been investing about 24,000 rupees per month in mutual funds. I've been doing this since the last 1 year and I want to continue the same for at least the next 7 to 10 years. So please have a look at my portfolio and share your advice. So he's emailed us his entire portfolio. Let's have a look. There's Quantum Long-Term Equity Fund. He's got HDFC Balanced Fund, HDFC Midcap Opportunities Fund, Mirae Asset Emerging Blue Chip, MOSL Focus 35, SBI Blue Chip, and ICICI Pru Value Discovery. So, you know what, he hasn't really specified what his goal is or what he wants to save all of this money for. There's a specific goal in mind. But he's fairly clear, Feroze, that he wants to remain invested and continue investments via mutual funds. He has a diversified portfolio. How would you look at it? How would you rate it? What are the chops and changes that you'd make?
See, I think Prashant is looking at the right time frame, but Avan, you rightly highlighted that he has not mentioned his goals, and we hope that he has put the goals in place which keeps him committed for that long periods. Otherwise 7 or 8 years of discipline becomes tougher unless you've emotionally attached yourself to an objective which is a goal. Assuming that he has already done some goal setting and spent a weekend deliberating on what the goals have been, 7 to 8 years is reasonable long period to propel the portfolio using equity as the backbone, which I think he has done currently using 7 schemes. Of course, there are some schemes which require some modification, especially the Quantum scheme, Quantum mutual fund, which is basically a little more active in terms of asset allocation, and I am not in favor of Quantum because of its performance, and the risk adjusted return hasn't been as favorable. So that will be an exit in his current portfolio. ICICI Value Discovery Fund, which has moved its objective, it was largely a mid cap scheme, then it transformed itself, weighing towards the large cap. That's an exit. And lastly, Motilal Oswal 35 scheme has significantly underperformed the benchmark index and increased the concentration from 35 stocks down to 25 stocks. So these will be exit recommendations on his current portfolio. And he can add two other schemes, which I think will complement the rest of it very well, which is the Birla Sun Life Equity Scheme and the Franklin Prima Fund will complement the residual four score schemes which he has in portfolio. And I think he will not need to review it for the next year or two if he made this modification at this juncture.
Right, I hope you've taken note of that. There are a few chops and changes, but by and large, your portfolio seems to be fairly okay. And do remember to all of our viewers, if you're sending us your mutual fund portfolio, which you're most welcome to do so, please do try and keep in mind a sort of a goal or a specific idea that you're working towards. It certainly helps experts to give you a better assessment of your portfolio. Next up, we have a query coming in from Gopal Rai. He says, I'm an NRI living in Dubai with my family with 45 lakh rupees to invest over the next 6 months. So he asks, is it advisable to take a term insurance policy? What do you recommend? So help us understand firstly, Feroze, what exactly are the rules and regulations when it comes to an NRI, and what would be the most apt insurance policy?
See, I think if you're an NRI, I think it's a good decision, Gopal, to look at India as an investment destination, because from an economic standpoint, over the next couple of decades, we will be one of the largest economies in the world. So good decision that you have some roots in India and you're remitting money to India to make sure that if it's time to get back home after having worked in another country like Dubai. So I think it's a good decision to skew money towards Indian economy. Point one. Point two, you have said that you wish to invest 45 lakhs in 6 months. In 6 months, for 6 months is a very different story. If it's very short term money, if I read that right, then I think you should only stick to liquid funds, the 45 lakhs, if you need the money back in 6 month period. That's HDFC liquid fund should be a good liquid fund, or a Birla Cash Plus. These are the two liquid funds I would recommend for your 45 lakhs. Then the third portion of your query, which is term plan, I think a term plan, you can definitely buy a term plan in the Indian competitive environment. The term plan of each crore comes between the range of 12,000-13,000 rupees per annum to as much as maximum about 32,000 rupees an annum, depending on the age bracket. You can definitely look at HDFC Click to Protect, which you can buy online. And that will remove the agent commission, which will bring down the cost and to the most competitive levels it could ever get, Gopal.
Right. I hope we were able to help you out. Firstly, the fact that you're even looking at, taking an insurance policy and looking at investing in liquid funds, that is really the way to go. And some recommendations have been given. Well, our phone lines are buzzing, Feroze, so let's get straight to it. We have Vashishta joining in from Bengaluru with a question. Hi there. Thanks for connecting with us. What's your query?
Is ULIP good investment option for a 35-year-old on a long-term basis, given the sudden change in tax structure? And this is for creating a wealth for the children. So I'm looking at a 20-year lock-in for a ULIP. Do you think it's a good idea?
I'm glad that you specified your goal. It's long-term, it's for your children. With the changes in tax regime, is there any reason, Feroze, that he shouldn't be looking at ULIPs? What is your advice?
See, I think a ULIP is a no-no. Of course, now there is a tax arbitrage. ULIP is one of the items, one of the fewer ones where the capital gain tax is still exempt. So I don't think a tax arbitrage could be the primary driver of one's motivation to choose a product. ULIP has been a underperforming product. If we did an analysis at Anand Rathi where you look at a mutual fund company and compare it with the same, if it's an ex HDFC's mutual fund, and then you compare it with HDFC's ULIP plan, a mutual fund combined with term plan, the maturity values are dramatically different, favoring the mutual fund plus a term plan combination. So I would very strongly recommend you against going for a ULIP even after 20 years. Of course, the costs look smaller in the long run, but the performances of these schemes have taken a dip because there is no pressure on the fund manager to be on the toes, because the money is locked in for long periods of time. If history has to be given some merit, even 1000 ULIP schemes which we analyzed have a return which is significantly lower, at least 6% lower than the corresponding mutual fund. So please don't use a ULIP, use mutual fund, be disciplined, and if you still want to complement it with an insurance to supplement your mutual fund investment, then go for a term plan. This will leave you at least twice as richer at the end of 20 years, if not more.
Okay, a term plan, mutual funds, a systematic way of going by it is definitely a preferred option over ULIPs, and I hope we were able to answer your query. Do remember, if you want a more detailed query on your entire portfolio, please email us on themoneyShow@etnow.tv. For now, we take a quick break. Keep those phone lines buzzing, keep your questions coming. Feroze Azeez is with us on the other side.